when we've seen oil up, the stock market goes down, and then gold tends to follow the stock market. So believe it or not, gold to me, ever since this mega run in late 2025 into 2026, gold became let's get in gold because it's a get rich quick and it's going to, and again, for those of us that have been in gold for years and years and years, it's not really like that. And so it's taken on this other form of a risk asset. And until it flushes those players out and resumes kind of being the safe haven asset, I would think that it does trade more so with the stock market. And we're seeing that today. I mean, oil's down, so you'd say, oh, well, gold should be up, but it's actually the stock market dropping that is taking gold down today. And again, that's that risk off play, which is weirdly enough impacting gold and causing it to sell off. I think that's what it is. I think people are getting a little bit, skittish about, number one, the liquidity needed for the SpaceX, Anthropic, OpenAI things. So they're kind of taking some chips off the table, maybe even to allocate to those. And then also just these AI stocks. When you're seeing these intraday trillion-dollar companies dropping 10% intraday, that's shocking. Like, again, I go back to the .com, and I mean, granted, it was a different time, but I mean, no company was a trillion-dollar company back then. And so you're seeing these type of moves on these names, and it does, as an investor, say, wait a minute, this volatility is scary at this point when you could see your account swing 10% intraday. And I think that's key. And then on gold, I'll show you this. This was a big event for me. The 200 moving average, we broke it a few days ago on Friday, and that to me tells me we're going to go lower. You can see we kind of kissed it right over here on the chart. We have this trend line. This was the low of this flush. We came right down there. We hit it right here. We got a small bounce and this break. And so I think we're heading towards this low at 4,100. And then if we break that, we're talking about in the 3,000 range, gold could be headed. This is great, because I want to buy more gold, and I want to personally buy more gold. And so let it come in, let it come in, and then it can go to $10,000. But I would like to buy some more below 4,000. Sure. No. And we shouldn't expect that. Like, markets don't work that way. If they had a big flashing neon sign that said that, it would be great, right? We'd be like, oh yes, this is wonderful. We can, all get in the party and get going and rocking and rolling here. But in reality, what we're seeing here is that gold is likely, if for me, it's all about the charts, right? And I have this beautiful parallel that connects these two lows and these highs, and I'm looking for a flush down in that range. And what's interesting about that is there's this longer term trend line on gold that goes right there. I mean, look at this trend line that goes back to 2023 or so, right through here. And you can see it goes right through the lows in 2020, what is this, 2024, late 2024, early 2025. And those two are coordinated right around that 3,600 level. So if we get down there, that's going to be the equivalent of a neon sign flashing saying, hey, this is the buying opportunity. For me, on a technical basis, we are now entering a very key support level between 66 and 64. We can see that here on the chart, we hit it here and we got a great bounce. We hit here, got a great bounce. We're now into it again. If it holds, awesome. If it breaks, honestly, likely down to 54, maybe even sub $50 silver, which again, interestingly enough, would bring us back into kind of this initial move and choppy sideways area. And I think, again, there's this even number at 50 where you'll have a lot of stops, so a lot of people will throw in the towel there, and that's usually the time when me as a buyer wants to step up and say, all right, everyone's given up on silver, now I start accumulating. Yeah, so certainly the dollar is the safe haven. It still is, even though de-dollarization may be slowly occurring. That's a 20-year plus thing, and you've seen the dollar creeping up here. Now, the key here is this level on the dollar. Going back on the DXY, it was major resistance over here, and then we had a breakout. It became major support. Then we broke back below. And as we can see, it's been major resistance. So the question is, can we break through this level? If we do, then you got some serious upside in the dollar. Right now, it's into resistance. But I think other places too. I mean, you will see eventually some institutional buying in gold. I don't think we're at that point. I know we'll talk about gold a little bit. Gold is taking another beating today, as we see here, because honestly, it's becomes kind of a risk on, risk off asset. But at some point, this starts to look very attractive at some key levels. And you're right, the treasuries are a great place. I mean, here you have stocks declining sharply today, AI stocks getting smoked 10% off of their intraday highs, and you can get a guaranteed 4.5% plus on a 10-year yield, right, on a 10-year bond. And so I do think these are places the park it. And you can see today the 10-year is down, which the 10-year yield is down, which is telling us people are buying bonds as the stock market is selling off here. Very likely we have higher inflation than 4.5%. But if it's the difference between being in the dollar and I run the risk of the dollar losing, or even staying the same and my dollar just stays the same, or being in assets where, if it's an AI trade, it could be down 10% today. You have to ask yourself, okay, I could make zero on the dollar. If it holds steady, maybe it goes up 1 or 2%, or I could lose money in certain stocks. Getting a guaranteed 4.5%, maybe offsetting inflation, at least it allows me to keep my capital ready to deploy when stocks get much, much cheaper. And then again, that creates this upward pressure on yields. Again, if the stock market pulls back, and I will say this, is that I think the whole entire economy at this point hinges on the stock market. As long as the market's making new highs, they don't care where prices go. They're fine. And they're the ones spending the big money. They're the ones that are out there. Everyone else that's below that threshold is continually struggling, and they're not really the spenders. But as long as you keep the stock market going up, they're fine. But if the stock market comes in and they pull back on the purse strings, that's where you see that potential weakness in the economy, and that's where we could see actually yields starting to come in pretty sharply. But I do think you're seeing it, and we've started to see just since late last week that the semiconductors, are starting to weaken a little bit. And my guess is we're seeing some selling pressure in those. Not only were they ridiculously overbought to the upside, but people are just taking some profits because they want to use some of that money to put into SpaceX when it does debut on Friday. So my guess is that is causing some of the drop in the stock market today and last Friday. Yesterday, we got a very weak bounce in the S&P. But my guess is it's not just that. It's this overvaluation and these kind of bubble mentalities. In fact, we even just heard from Bank of America advising its clients just yesterday to sell and take profits because there's too many similarities to the dot-com bubble. And I think that's a good warning sign as well. Investors have to be aware that there's a reason why these companies are rushing to the markets. They see that there's a window right now where investors are euphoric. That means investors are willing to pump money in at any valuation that they deem is sufficient. And that usually is a top signal. There's no doubt about that. Yeah, so you can see here I have the chart in front of me, and if we look at this, we can see that from the lows here where the Iran war really began and oil spiked up to $120, there's this automatic buy the dip mentality that has been ingrained really since COVID, but arguably even since the financial crisis. We always think that, the Fed will bail us out. The government will come out and do something. We've seen the president coming out and investing in stocks like Intel, which tells us that he's backstopping the market. We know he loves the market. And so it perpetuates this feeling that the markets can't lose. Like if you invest, maybe you'll see a dip, but within weeks you'll be at new all-time highs, and therefore you buy into it very, very quickly. You throw in the AI kind of euphoria, and you have a recipe for what we've seen here, which was this incredible rally in the S&P that seemed to go on forever. But the problem is, once it broke this trend line, we're seeing this big pullback and retrace right now. But there's no doubt about it that it's this psychological impact of investors where we feel, because every time we've seen a drop of 10 or 20%, we see ourselves back at all-time highs, and that kind of conceives that notion that you just got to buy every dip, and that makes these big pops even bigger. When we look at a chart, we say, okay, we had a bull move here, and then we pulled back, and then we broke out above. And so what ends up happening is that former high pivot right here ends up being your next technical support. And so if we look at that and say, okay, well, on the S&P 500, where would that be? It would basically be in this range right here, right around that 7,000 even number. That would be that first attempt by the bulls to hold the line. Now, the bears will try to push through it, but this would be a very, very good level where you'd expect a bounce on the markets. Right now, momentum is still in the favor of the bulls, but today may be the flipping point, and I'll show you why on the charts here. And so when you're looking at a bull market, you usually look at highs and then a higher low, higher high, higher low, higher high, higher low, right? And that's what we've been seeing. We saw this big move up, sideways, big move up to a new high, pullback. But this low here, this one was higher. For the first time today, this low has now taken out the low of the previous pullback. And again, that starts to tell us that there's a potential change in the guard here from the bullish sentiment to the bears now gaining the upper hand. And this is going to be really interesting because with the SpaceX IPO, investors, the big institutional money, they don't want the markets to collapse here because that will make more investors come Friday when the IPO debuts. It'll make them a little bit more cautious on buying into that IPO when it becomes public. And they need these IPOs to have great debuts so that obviously they make their money and it looks good on their track record. First off, I would say it adds additional risk to investing in the S&P. I mean, how many IPOs, like look at CBRS, Cerebras, which is a semiconductor. This was given to the public or given to the pre-IPO investors, so kind of the insiders at $180. It opened day one at 350, goes up to 380, and it's literally gone straight down since then. So, if we look at this, and I don't know if you remember the Facebook IPO, but the Facebook IPO was so hyped up, it opened and then it literally went straight down for months before it bottomed out. And so when you're including something that's a valuation of 1.8, 1.75 trillion in the index very quickly, it actually means that the index is at additional risk because if that fade occurs and it's that big of a company, it's going to drag down the S&P 500. It's definitely a lot of the Mag 7, but more than anything, it's the AI trade. I mean, you're looking at stocks like, Micron, right? I mean, Micron opened